For years, crypto in Kenya has lived in the gray zone. It wasn't illegal, but it wasn't recognized either. Exchanges operated like ghost ships, visible but without a flag. Investors traded millions daily, yet no one really knew who was watching or if anyone was. And that limbo has changed. Kenya's Virtual Asset Service Providers Bill, known as the VASP Bill, marks the first serious attempt to bring digital assets under a legal framework. And whether you love regulation or hate it, this act is about to reshape how crypto lives, breathes, and operates in East Africa's biggest fintech market. Now, let's start with what this act actually is. In simple terms, it's a law designed to regulate virtual asset service providers. That means exchanges, wallet providers, token issuers, and anyone dealing with digital assets in Kenya. Think of it as a Kenya's version of Europe's MICA regulation or Singapore's Payment Services Act, a move that brings crypto from the shadows into the formal financial system. But here's the twist. This isn't just about setting rules for crypto traders. It's about defining legitimacy. And for the first time, the government is saying we recognize virtual assets as a part of the financial ecosystem. That sentence alone is historic. The act does a few big things. First, it introduces the concept of a virtual asset service provider license. You can't just open an exchange or issue tokens anymore. You'll need approval from Kenya's financial regulators, primarily the Capital Markets Authority, CMA, and the Central Bank of Kenya, CBK. It also brings in the Financial Reporting Center, FRC, to monitor anti-money laundering and terrorism financing compliance. Second, it sets out clear definitions, and that's a big deal. It distinguishes between virtual asset, virtual service tokens, and non-fungible tokens. Virtual assets are digital representations of value that can be traded or used for payments. NFTs are recognized but only regulated if they are used for payment or investment. That distinction means artists and creators can still mint NFTs freely unless they start selling them as investment products. Third, it outlines who is in charge. The CMA will handle investment-related activities, think token offerings, asset management, and advisory services. The CBK will oversee payment systems, wallets, exchanges, and anything that touches fiat money. That split mirrors what Singapore did, where the Monetary Authority of Singapore divides oversight based on activity type rather than company type. It's a modern approach. But beyond the technicalities, the act signals something deeper. Kenya wants to position itself as a serious player in blockchain regulation, not a frontier market that bans fast and studies later. Remember in 2023, the Central Bank of Nigeria reversed its crypto ban after realizing that prohibition does not stop innovation. It just pushes it underground. Kenya's taking the smarter route. Regulate, don't suffocate. Now, why is this moment so important? Kenya is already one of the most crypto-active countries in the world. According to Chainalysis, Kenya consistently ranks in the global top 20 for crypto adoption, driven by youth, mobile money culture, and peer-to-peer trading. MPESA users already understand digital value exchange, so it's not a big leap from sending airtime to sending BTC. What's been missing is trust and structure. This bill wants to do that. Still, crypto enthusiasts are split. On one side, you've got the optimists, people saying, finally, we are getting clarity. They see it as an opportunity for Kenyan projects to attract institutional investment, to tokenize assets legally, and to build exchanges that don't fear sudden shutdowns. On the other end, skeptics worry about government overreach, and they ask, who sets the licensing fees? Will startups survive the compliance costs? And more importantly, will this law be used to control innovation instead of enabling it? That tension between protection and progress is the heart of every crypto regulation debate worldwide. In the EU, MICA aimed to bring stability and investor confidence, but it also introduced complex registration requirements that many startups find expensive. In the US, overlapping jurisdictions between the SEC and CFTC have created confusion, and Kenya is trying to avoid these mistakes, but we'll see if it can. Another interesting piece of this act is how it addresses initial virtual asset offerings, or ICOs. It introduces a process similar to how companies go public in trad finance. Issuers must get approval, publish offering documents, and operate transparently. In theory, this could protect investors from the rug pulls and token scams that have plagued Africa's early crypto scene. But in practice, it might make launching a project more bureaucratic than innovative. Striking that balance will determine whether Kenya becomes the Singapore of Africa or just another overregulated market that scares talent away. What stands out most is the language of intent in the act. It doesn't demonize crypto, it integrates it. It talks about innovation, financial inclusion, and emerging technology. That's a positive signal to entrepreneurs and investors who've been waiting for a sign that Kenya is not planning a crypto crackdown. And here's a global context. While Kenya is still catching up, it's not far behind. The EU's MiCA came into force in 2024. Singapore's PSA has been operational since 2020. South Africa's FSCA started licensing crypto asset service providers in 2023. Kenya is simply aligning itself with a growing international standard, one that says crypto is not the enemy, it just needs guardrails. The irony, of course, is that regulation could make Kenya even more attractive to crypto investors than countries with bans or unclear policies. Institutions love clarity. Hedge funds, venture capitalists, payment companies, they don't want legal chaos, they want rules that they can operate under. So while this act might feel heavy-handed at first, it's possible it could open the floodgates for serious money to enter Kenya's Web3 scene. But let's be real. Laws alone do not guarantee progress. Implementation will be everything. Kenya's regulatory agencies must act with transparency, consistency, and speed. And if licenses take a year to process, or if every crypto exchange faces random inspections, the ecosystem will stagnate. What we need is a regulator that sees itself as a partner in innovation, not a gatekeeper of control. And the Virtual Asset Service Providers Act is not perfect. It's a framework. But every strong ecosystem starts there. Look at how Estonia built its digital economy. It began by regulating e-residency and digital signatures, not by banning what it did not understand. Kenya has that same potential right now. This act is Kenya's handshake with the blockchain world. It's saying, we are ready to play, but here are some of our rules. That is huge, especially for the economy, for investors, and for the future of financial innovation on the continent. In the next episode, we'll dive deeper into what Kenya got right, because believe it or not, some truly progressive, well thought out sections of this act could put the country years ahead of the regional peers. Stay tuned.